two most important factors, and they're pretty simplistic, but basically if a stock is trading on a very high historic yield, particularly greater than 10%, if a stock's trading on greater than 10% yield, so you look at last year's dividend by today's share price, there's usually a giveaway of something wrong with that stock, because 10% is significantly higher than the market. The market average yield's about 4.5% in terms of cash, 6% if you include franking. So if you're sitting at 10% cash yield, then that suggests it could be too good to be true. One of the reasons why that stock is probably trading at 10% yield is the share price has probably collapsed since last year. And that's the second giveaway. If the share price has fallen 30, 40, 50%, that is usually a pretty good sign that the market's telling you there's something wrong with that stock and it's probably going to cut its dividend. Those are the two most important factors. Now, the trouble is I think people get sucked in by the high yield. Oh, it's trading on a 10% yield, fantastic, I get this dividend. But, Metcash was trading on a 17% grossed up yield 2 years ago. Because its share price had fallen, its business was under pressure. Next week it announces it's not going to pay a dividend for 18 months. So you don't get 17% yield, you get zero yield, and the stock price fell 30%. And that's typically what happens if a stock cuts its dividend. So you've got to be very wary of those sorts of stocks. Other things are just looking at, the underlying business, what's happening there. Last year it was very, very obvious that BHP was going to cut its dividend because its share price had been falling. Its yield did look historically quite high. But the underlying business 12 months ago, not now, but 12 months ago, iron ore prices had been falling. It also had that Samarco issue, so it had all sorts of problems. All of its commodities were going down. Its oil and gas in the US was underperforming. All those were negatives. And so it was pretty obvious to us they're going to cut the dividend. The board tried to sort of say, no, we won't cut, we can't. But if they hadn't cut the dividend last year, they would have been on a payout ratio of about 250%. And if you're paying out 2.5 times what you earn, well, you can't do that. You might be able to borrow for 1 year, but really that's totally unsustainable. And that's the other factor we look at is companies whose payout ratio is too high. If it's over 100%, unsustainable. And in fact, even if it's close to 100%, we get worried. So the higher the payout ratio, the more concern you have as well.